Welcome to episode 12 of Nova Bourse US. Today, we are moving from theory into the mechanics of the professional investor's toolkit. We are going to cover DCF valuation step by step, showing you how to value a company using nothing but a spreadsheet and one logical formula at a time. Every other valuation tool you encounter tells you what the market thinks about a stock. But a discounted cash flow analysis, or DCF, tells you what a company is actually worth based on the cash it will generate. While price-to-earnings ratios compare price to accounting earnings, and enterprise value to EBITDA ratios compare you to peers who might themselves be overpriced, DCF starts from zero. It builds an intrinsic value from a company's own fundamental performance. In this episode, we will value Coca-Cola live, using real balance sheet figures and current treasury yields with a spreadsheet model that you can easily replicate at home. To understand why this method matters, look at 1988. That was the year Warren Buffett bought roughly $1 billion of Coca-Cola stock while the rest of the market was skeptical. His logic wasn't based on chart patterns or momentum. He simply projected the present value of the company's future cash flows, realized the market price was far below that intrinsic value, and acted. That position grew more than tenfold over the next decade. DCF is not just an academic exercise. It is the ultimate tool that separates the price you pay from the value you receive. Today, we are applying that same framework to Coca-Cola, updated for the year 2026. A DCF model is composed of exactly three moving parts. First, the numerator, your projected unlevered free cash flows for an explicit forecast period, usually 5 years. Second, the denominator, the weighted average cost of capital, or WACC, which acts as a discount rate reflecting the risk of those cash flows. Third, the terminal value, which captures all cash flows from the end of the forecast period into perpetuity. Your enterprise value is simply the present value of those forecast cash flows plus the present value of the terminal value. Every other number in your model serves one of these three masters. Let's define the numerator, unlevered free cash flow. This represents the cash a business generates from operations available to all capital providers before any debt payments are made. It is called unlevered because it is independent of the company's specific capital structure. The logic is straightforward. If you owned the entire business, debt-free, this is the cash that would land in your pocket each year after maintaining and growing the asset base. We use this specific metric because we want to value the business first and subtract debt later, rather than mixing up operating performance with financing decisions. To calculate this, we use a standard formula that starts with EBIT, earnings before interest and taxes. First, multiply EBIT by 1 minus the tax rate to get your after-tax operating profit. Next, add back depreciation and amortization, because these are non-cash charges that don't actually leave the bank account. Then subtract capital expenditures, which is the cash spent on physical assets, and finally, subtract the change in net working capital, which accounts for cash tied up in inventory, receivables, and payables. The final result is the actual cash available to both shareholders and lenders. Looking at Coca-Cola's recent performance, the company reported free cash flow of approximately $9.8 billion in 2023, $4.8 billion in 2024, and $5.3 billion in 2025. That 2025 figure includes a $6.1 billion one-time payment related to the Fairlife acquisition. If we exclude that, the underlying cash flow was $11.4 billion. This volatility is why DCF requires judgment. A naive model extending 2024 would understate the business, while blindly using the $11.4 billion would overstate it. We need a normalized base to be accurate. For our live valuation, we will set a normalized base of $9.5 billion, which is the midpoint between the 2023 clean figure and the 2025 ex-Fairlife figure. We will then apply a 5% annual growth rate for years 1 through 5, which aligns with Coca-Cola's own 2026 guidance for organic revenue growth. This gives us projected cash flows of approximately $10 billion in year 1, $10.5 billion in year 2, $11 billion in year 3, $11.6 billion in year 4, and $12.1 billion in year 5. These are the figures we will discount. Now for the denominator, the weighted average cost of capital. This answers the question: what rate of return do all capital providers, both shareholders and lenders, collectively require from this business? It is your hurdle rate. If the company earns more than this, it creates value. If it earns less, it destroys it. In a DCF, the WACC converts future cash flows into today's dollars. A higher WACC makes future cash worth less today, lowering your valuation, while a lower WACC does the opposite. Getting this right is critical because the terminal value alone typically represents 60 to 80% of the total enterprise value. To calculate the cost of equity, we use the capital asset pricing model. The formula is the risk-free rate plus the product of beta and the equity risk premium. The risk-free rate compensates for the time value of money, while the risk premium compensates for the extra risk of stocks over bonds. Beta measures how much a stock moves relative to the market. A beta above 1 is more volatile than the market, and below 1 is less. Coca-Cola's beta of 0.35 tells us it is roughly one-third as volatile as the S&P 500. Beta is not just an abstract statistic. It describes real business behavior. Coca-Cola's low beta reflects a business that sells affordable habitual beverages in 200 countries. People don't stop drinking Coke when the market drops 20%. In contrast, Nvidia carries a beta closer to 1.3 because semiconductor demand is tied to cyclical capital spending. Utility companies often have betas below 0.5, while early-stage biotech firms can exceed 2. When you see a beta, you're seeing the market's collective judgment on revenue stability, cyclicality, and operating leverage. For the risk-free rate, we use the yield on the 10-year U.S. Treasury bond, which stood at approximately 4.18% at the start of January 2026. This represents the return investors can earn with virtually no default risk. The equity risk premium is the extra return demanded for holding stocks instead of treasuries. Aswath Damodaran of NYU Stern estimated this implied U.S. equity risk premium at approximately 4.23% for January 2026, which is slightly above the historical average of 4.25%. Together, these two inputs form the foundation for every U.S. stock's cost of equity. Plugging Coca-Cola's inputs into the model, we get a cost of equity of 5.66%. That is 4.18% from the risk-free rate, plus 1.48% from the risk premium contribution. Because Coca-Cola has such a low beta, its exposure to market risk is dampened. Compare this to a high beta stock like Nvidia, which at a beta of 1.3 would have a cost of equity of approximately 9.68% using the same market inputs. That 4 percentage point gap is exactly why stable, low volatility businesses command premium valuations in the eyes of investors. Next, we determine the cost of debt. We take the trailing 12-month interest expense of $1.7 billion and divide it by the total debt of $44.7 billion, giving us a pre-tax cost of debt of approximately 3.5%. However, interest expense is tax-deductible. With an effective tax rate of 17.7%, we multiply 3.5% by 1 minus 0.177 to get an after-tax cost of debt of approximately 2.87%. This tax shield is the primary reason why companies choose to use debt financing even when they have access to equity. To assemble the final WACC, we blend these costs based on their share of total capital. With a market cap of $359 billion and debt of $44.7 billion, equity makes up 89% of the capital structure, and debt makes up 11%. We take 89% of our 5.66% cost of equity, plus 11% of our 2.87% after-tax cost of debt. Adding those together, we get a WACC of approximately 5.35%. This is the discount rate we will use to bring those future cash flows back to the present. Now we reach the terminal value, which captures all cash flows from year 6 to infinity. Since we cannot forecast individual years that far out, we use two shorthand methods. The first is the Gordon growth model, or perpetuity growth, which assumes cash flows grow at a constant rate forever. The second is the exit multiple method, which assumes the business is sold at the end of our forecast for a multiple of EBITDA or revenue. Professional analysts always calculate both to cross-check their work. If these two methods produce wildly different results, it means your assumptions are inconsistent and you need to adjust them. Using the Gordon growth formula, we take our year 5 cash flow of $12.1 billion, multiply it by 1 plus a perpetual growth rate of 2.5%, and divide that by the difference between our WACC and that growth rate. With a WACC of 5.35% and a growth rate of 2.5%, the terminal value comes out to approximately $436 billion. A 2.5% growth rate is conservative for a global leader like Coca-Cola, sitting right between long-term inflation and general economic growth. The exit multiple method offers a sanity check. If we multiply our projected year 5 EBITDA of $19 billion by a conservative multiple of 10 times, we get a terminal value of only $190 billion. This is far lower than our Gordon growth result, signaling an inconsistency. If we back out the implied multiple from the Gordon growth value, it suggests a 23 times multiple, which is too high for the beverage industry. Conversely, a 10 times multiple implies a growth rate of only 1.8%. The truth lies between these bounds, which is why DCF is a range tool, not a precision instrument. Now, let's perform the spreadsheet magic. We discount each of our 5 projected cash flows back to today using our WACCs of 5.35%. $10 billion in year 1 becomes $9.5 billion today, and so on for years 2 through 5. We also discount our $436 billion terminal value back 5 years, which gives it a present value of approximately $334 billion. When we add the present value of our 5 yearly cash flows to the present value of the terminal value, we arrive at a total enterprise value of approximately $382 billion. Enterprise value is the price to buy the whole business, debt and all. To find the equity value for shareholders, we subtract the net debt. With $44.7 billion in debt and $13.8 billion in cash, the net debt is $30.9 billion. Subtracting that from our enterprise value leaves us with an equity value of $351 billion. When we divide that by the 4.3 billion shares outstanding, we get a value of approximately $82 per share. Since Coca-Cola trades around $83, our model suggests the stock is fairly valued, with very little margin of safety at this price. A DCF without a sensitivity analysis is just a guess with decimal points. The variables that matter most are the WACC and the terminal growth rate. If we raise the WACC to 6.5%, our share price estimate drops to $68. If we lower it to 4.5%, the price jumps to $102. Similarly, changing the growth rate by just 0.5% shifts our value by several dollars per share. That range of $68 to $102 is the honest output of our model. The $82 figure is just the midpoint of a distribution. The real lesson here is that the goal of a DCF is not to generate a price target accurate to the cent. The goal is to force you to think about what actually drives value. Is the cash flow growing or shrinking? How risky are those flows compared to the market? What is a reasonable long-term growth rate for this industry? The spreadsheet is just scaffolding for these judgments. Warren Buffett didn't need Excel to value Coca-Cola. He understood the business, estimated the cash flows, demanded a margin of safety, and acted. The DCF framework simply makes that logic explicit, repeatable, and comparable across different companies. In the next episode, we are going to tackle a question that every DCF depends on but rarely answers directly. Who are the right peers to compare against? We will explore how to build peer groups and explain why companies like NVIDIA are not truly comparable to Intel, even though both manufacture chips. It is a critical step in fundamental analysis that you do not want to miss. I will see you in episode 13.